Hi, I'm Audie. Today, I want to talk about why generating income through selling options can be more attractive than simply trading stocks, what the advantages are, and most importantly, how to reduce risk. Before anything else, I want to be very clear. Option selling is not free money. When used properly, selling options can create cash flow, take advantage of time decay, and benefit from volatility. But if it is done without proper risk management, it can become much more dangerous than simply buying and selling stocks. So the real idea behind option selling is not just making easy income. It is about using probability, time, and control, not just direction, to repeatedly collect option premium in a controlled way. Let's look at the main difference between stock trading and option selling. With regular stock trading, you usually need the stock price to move in your favor. For example, if you buy a stock at $100, you need it to go to $105, $110, or higher to make a profit. Of course, you can short stocks, but for many individual investors, shorting can be difficult psychologically and risky from a margin perspective. It relies entirely on perfectly predicting the direction. Stock trading is fundamentally a game of precise directional prediction. Option selling is different. When you sell options, the stock does not necessarily have to move sharply in your favor. The stock can go up, move sideways, or even move slightly against you, and you may still make money. That is one of the biggest advantages of option selling. For example, let's say a stock is trading at $100. If you simply buy the stock, you need the price to rise to make money. But if you sell a $90 put option, you can make money as long as the stock does not fall significantly below $90 by expiration. In other words, option selling is not always about perfectly predicting direction. It is more about creating a structure where the stock just needs to stay above or below a certain price. When you look at the stats, you can see why option selling can have a wider profit zone. When you buy a stock, the win condition is that it must move favorably. With option selling, the win condition is that it can move favorably, sideways, or even slightly unfavorably. The stock can move in a wider range, and you may still make money. For example, if a stock is trading at $100 and you sell a $90 put, the stock can fall to $97 or even $92, and you may still profit depending on the premium you collected. So, option selling is less about being perfectly right and more about creating a zone where you can still be profitable. Another major advantage is that option selling puts time decay on your side. Options have expiration dates, and as time passes, the option's time value gradually disappears. For option buyers, time works against them. If the stock doesn't move fast enough, the option loses value. But for option sellers, you harness time. You collect the premium up front. As time melts away the option's value, you get to keep the difference as profit. A simple way to explain it is, stock trading is mostly about being right on direction. Option selling allows you to use both direction and the passage of time as part of your strategy. Let's talk about generating immediate cash flow. With regular stocks, you wait to sell or collect dividends to realize a profit. When you sell an option, you receive the premium the moment you open the position. This creates consistent cash flow when repeated systematically. That is why many traders use option selling as a way to create income. Common strategies to do this include covered calls, cash-secured puts, the wheel strategy, and credit spreads. A simple example of this is the cash-secured put, which lets you get paid while waiting to buy a stock at a discount. Let's say a stock is trading at $100, but you only want to buy it at $90. Instead of just waiting, you sell a $90 put option and collect $2 in premium upfront. Two things can happen. Outcome A, the stock stays over $90 and you keep the $2. Outcome B, the stock falls below $90, so you buy the stock. But because you collected that $2 premium, your real break-even price is $88. It allows you to get paid while waiting to buy a stock at a price you already like. Another core strategy is the covered call. This means generating extra income on shares you already own by selling upside call options. For example, if you own a stock at $100 and you don't think it will rise above $110 soon, you can sell a $110 call and collect premium. The benefit is you lower your overall cost basis with that upfront premium. But there is a trade-off. The limit is that if the stock skyrockets, your maximum profit is capped at your strike price. A covered call works best when you are perfectly comfortable selling the stock at your chosen strike price. Now, option prices are not determined only by stock direction. They are driven by how much movement the market expects. This is called implied volatility, or IV. When the market is fearful, investors pay more for protection, pushing premiums higher. This means high IV equals a nervous market, which equals high premium. Higher volatility benefits option sellers because you can collect more premium upfront, which also improves your break-even point. And if you sell when volatility is high and the market calms down, the options price collapses. This is called IV crush, and it allows sellers to buy back the option much cheaper. A great way to understand this is to compare option sellers to an insurance company. Option buyers pay high prices for protection or massive leverage. Option sellers act like the insurance company, collecting those premiums to absorb that risk. But here is an important warning. High premium is not free money. You are being compensated for underwriting market risk. If an option that normally trades for $1 suddenly trades for $5, it usually means the market is expecting a massive move. High volatility creates better opportunities, but it requires much stronger risk management. This brings us to the biggest boss fight in option selling: unmanaged risk. Option selling can produce many small wins, but one large loss can wipe out your account. A high win rate does not automatically mean a strategy is safe. The dangers include naked calls, which carry a theoretically unlimited loss if a stock keeps rising. Naked puts can cause massive losses if a stock crashes toward zero. There is also gap risk, where overnight jumps during earnings or market shocks leave you unable to react. Risk management is not optional. It is the foundation. Because high volatility means higher risk, it is often safer to use defined risk strategies, like credit spreads, to cap your maximum worst-case scenario. How it works is simple. Instead of just selling a $90 put completely naked, you sell the $90 put and buy an $85 put underneath it. Your maximum loss is now hard capped at that $85 floor. The question you ask yourself is no longer just, how much premium am I getting? But is the premium worth the defined risk I am taking? Option selling is not just a return game, it is a survival game. Here is your survival guide. First, keep position size small. No single trade should ever damage your account. Second, trade quality. Only sell options on stocks or ETFs you'd be happy to own. Third, avoid event risk. Beginners should avoid selling right before unpredictable earnings announcements. Finally, have preset exits. Take your profits early mechanically and cut losses before they escalate. Having these rules before entering a trade is much better than making emotional decisions later. The real power of option selling is that you are no longer just guessing direction. The ultimate advantage is control. You are configuring the exact variables of your trade. You choose your exact probability of profit. You define your exact expiration timeline. And you structure your absolute maximum worst-case scenario before you even enter the trade. This changes the questions you ask. Instead of, will the stock go up? You ask, what price am I comfortable with? And how much premium makes this risk worthwhile? To wrap it all up, selling options offers incredible benefits. The stock doesn't always need to move in your favor. Time decay works for you, and you can generate consistent cash flow. But remember, high premium is compensation for high risk. The core of option selling isn't chasing premium, it is managing risk. Stock trading is mainly a game of direction. Option selling is a game of price, time, volatility, probability, and risk control. That is what makes it powerful, but only if it is managed with strict discipline. Master the game, and you can turn option premium into a repeatable strategic process. Thanks for watching. Just remember, investing in options involve risk and aren't for everyone. So treat this as an educational guide for your financial journey. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.